Something shifted beneath the surface of the American economy, and it's not what most experts were predicting. The average investor sees the headlines, jobs stable, inflation softening, but there's something deeper happening beneath those numbers. And it could mark the beginning of one of the most deceptive economic turns in recent history. Consumer confidence has suddenly spiked. And while that might sound like good news on the surface, it's created a volatile question that no one seems to want to answer directly. Is this surge real? Or is it the final gasp of momentum before a long overdue consumer pullback? As of mid-June 2025, the University of Michigan's Consumer Sentiment Index climbed to 60.5, up sharply from 52.2 just 1 month prior. That's a nearly 16% surge, the largest month-over-month improvement since the early pandemic recovery. This isn't just noise. It's a statistical anomaly that demands explanation. Some critics argue that the university's methodology has become less reliable due to a heavier reliance on online panels post-2020. Still, the jump is too large to dismiss. Even adjusted for sampling errors, sentiment is clearly improving. And here's the second piece of the puzzle. Inflation expectations are falling. One-year inflation outlooks now sit at 5.1%, down significantly from 6.6% in May. 5-year expectations have eased to 4.1%. That matters a lot. When consumers start expecting lower inflation, they tend to become more comfortable making larger purchases again. Retail sales data adds another dimension. The most recent reports show a 4.2% year-over-year increase in May, with core retail sales excluding gas, vehicles, and restaurants ticking up 0.2% month-over-month. These aren't explosive numbers, but they show stable growth. Looking closer, we can see how the American consumer is shifting spending priorities. Digital products including ebooks, online courses, and video games surged by 28% year-over-year. Sporting goods rose over 8%. Meanwhile, sectors tied to home renovation and large-ticket projects like building materials and garden supplies dropped by more than 7%. What's clear is that Americans are now choosing to spend on themselves, leisure, fitness, entertainment, rather than long-term household upgrades. The big-box home improvement boom that defined post-COVID consumer habits appears to be slowing. Why now? Several macro-level factors help explain it. For one, inflation appears to be softening across the board. The latest Consumer Price Index numbers show a 0.1% monthly increase, with core inflation coming in below expectations. Energy prices have stabilized, and wage growth, while steady, is no longer surging. This gives people breathing room. The labor market also remained resilient. May added 139,000 jobs, and the unemployment rate held firm at 4.2%. While not a booming number, it's strong enough to maintain household incomes and consumer stability. Then there's the trade front. A de-escalation in tariff threats with China and the EU has eased pressure on imported goods, helping to stabilize prices on everything from electronics to groceries. When consumers see stable shelves and consistent pricing, they tend to feel safer opening their wallets. But let's zoom in on a stat that should make everyone pause. A recent poll found that 44% of Americans expect their financial situation to worsen over the next year. That's the highest level of pessimism since records began in 1978. So what's going on here? Confidence is rising, but anxiety is rising too. That contradiction could be the most important signal of all. It tells us this: the consumer surge may not be sustainable. It could be a final burst of activity before reality kicks in. Or it could be the start of a new phase in how Americans view risk, inflation, and spending. Let's talk about what this means for markets. If consumers continue shifting their dollars into digital goods, fitness, streaming, and personal enrichment, the companies in those sectors could see unexpected revenue boosts. Think subscription platforms, e-commerce niches, and direct-to-consumer fitness brands. On the flip side, if the home renovation slowdown persists, companies like Lowe's, Home Depot, and legacy furniture retailers might see earnings compression. These stocks boomed in 2021 through 2023, but cracks are now forming. There's also the looming influence of monetary policy. The Federal Reserve has signaled flexibility, but they are watching this consumer surge closely. If sentiment keeps climbing and spending spikes, even modestly, it could influence rate decisions. While the Fed wants to encourage stability, it cannot ignore the risk of reigniting inflation if demand outruns supply. And this brings us to the elephant in the room: the national debt. As of June 2025, U.S. debt stands at $36.2 trillion. Servicing that debt now costs over $1 trillion annually, a figure that rivals the entire defense budget. That cost increases with every percentage point rise in interest rates. So even if the Fed doesn't want to raise rates, it may be forced to maintain credibility in the bond market. If consumer confidence drives yields higher, or if international creditors begin to doubt America's long-term fiscal stability, things could change rapidly. Foreign buyers have already reduced their share of Treasury holdings over the past 12 months, putting more pressure on domestic buyers to absorb debt issuance. Now consider 3 possible scenarios for the rest of the year. First, the boom path. Confidence stays strong, inflation remains subdued, and spending continues rising into Q3. Retail earnings beat expectations and markets rally on consumer momentum. Second, the burnout path. Confidence fades quickly as debt fears and inflation concerns reemerge. Spending stalls, markets correct, and the Fed pauses again. Third, the policy collision. Inflation picks back up or geopolitical tensions trigger energy price spikes. The Fed is forced to act, raising rates and freezing consumer growth. Any of these paths could emerge. But here's the psychological hook that most people miss. Consumer behavior is largely self-fulfilling. If people believe good times are here, they spend. That spending creates demand, which creates growth. But the opposite is also true. Fear is contagious, and once it takes hold, reversals can happen fast. To make smart financial decisions right now, you need to read beyond the headlines. Don't assume that rising confidence means lasting strength. Watch where the money is actually going, not where people say it will go. Monitor shifts in savings rates, credit usage, and category-level spending. And here's a stat worth remembering. Retail sales in May already outpaced the year prior by 4.2%. If June data, set to be released in 2 weeks, shows a similar jump, it will be the clearest signal yet that consumers are truly driving a real recovery. But we're not there yet. The next 30 days could determine the entire narrative for Q3. We'll get updated CPI numbers, the Fed's next rate outlook, and official June retail sales data. Each of those has the power to confirm or collapse this newfound optimism. Don't forget the longer-term backdrop. With interest costs on the national debt climbing every day, any rate hike, even one, magnifies the government's fiscal strain. And that, in turn, raises recession risk, investor skepticism, and potential long-term tax impacts. The short-term trend looks bright. The long-term picture is still uncertain. This is a rare moment in economic cycles when psychology matters more than policy, and perception may move markets faster than fundamentals. Stay sharp. Track the data, watch sentiment. Because if this confidence boom turns out to be real, it could fuel one of the biggest second-half rallies in years. And here's one more undercurrent that could flip everything again: consumer credit. While spending may be rising, so is credit card usage. In fact, revolving credit hit an all-time high in May. If wages don't catch up, this could quietly cap spending power by August. Keep an eye on delinquencies. If they tick upward, confidence could reverse faster than most anticipate. The summer ahead may look sunny, but storms form quietly at first. If you want real-time updates on this evolving story, hit subscribe now.